Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. How are you this morning, Tyler?
Good morning, Dean. I'm doing great. How about yourself?
Good. Thank you. Thank you. Today, we're going to be talking about overcoming bad investment habits. This is something that Tyler and I put together as a topic because we talk to investors all day long. And we hear some of these bad habits come up quite often. So we figure if we can address some of these bad habits, it's going to help you, the listener, as an investor. So we're going to look at these individually. The number one bad habit we see, and we would love to have investors overcome, but it's a tough one, is selling investments based on emotion. We are in a significantly volatile market right now. We're very geopolitically driven as a market. The market is showing instability. One day, the next day, we'll go for a gain. We'll have an 800-point loss. I mean, it's jumping all over the place. So we have a lot of investors that are nervous about that, and you should. As a human, you're going to be nervous when the market jumps around like that. But what typically happens in a situation like this is investors will look at such a short term, the course of a week, the course of a month, and want to make selling and buying decisions based on that. And if you were to step back and look at history and see, what a week looks like in the course of a graph over a year or 2 or 5 years, it's nothing more than a blip on the radar screen most times. So for instance, most recently here in the summer of 2019, again, we saw, 600-point swing, 800-point swings. And we would hear from certain investors, should they sell everything and wait it out? I tend to think that's one of the worst things you can do. Now, we like to be prudent, though. We like to have cash on the sidelines so we can buy investments in portfolios when the market does go down. So there's some significant gains that can be made there. But really, habit number one is selling investments based on emotion. Tyler, anything else with that?
Yeah, good points, Dean. Just a couple other things when it comes to selling investments based on emotion. The other thing with that is not sticking to a plan. So usually we see when people don't have a plan in place, they're kind of all over the place, so to speak, where they don't have a game plan, where either they buy and they continue to buy and they're doing dollar cost averaging, where they might be within their 401k or their Roth IRA, they might be buying in every single month, which is a plan over the long term. But people who don't have a plan, usually they're the ones that sell on emotion. And especially in the market that we've had lately, that could be a big mistake, because right now, as you mentioned, Dean, the market is very volatile, where the Dow might be down 2% one day and then it's up 3.5% the next day, or it's down 1% and then it's up 0.75%. So the last thing that you want to do is sell on a down day and then hear it rebounds back up and recovers that loss 2 days later. So usually when you sell like that, it's always based on emotion, but instead we'd rather see you, if you are going to do something like that, you want to sell on for example, maybe economic data, where there's data that comes out and it makes it look like the economy is not doing well. If companies' earnings reports are consistently decreasing, that might be a reason to sell. If there's certain company-specific data, for example, you might have something like a lawsuit or an accounting fraud there might be released, or something like Boeing, for example, where there was plane crashes, or where the planes weren't made properly. If there's different company-specific data that comes out, that might be a reason to sell a particular stock. Or another thing might be age or retirement milestones, for example, where as you get older, when you hit a certain age, you might want to rebalance your portfolio and be more conservative over time. So that would be a reason to sell investments, but none of those are based on emotion. All of those are based on a plan that you have moving forward. So again, habit number one, selling investments based on emotion. You don't want to do that. What you want to do is find a plan, stick to it, and then you can sell over time based on different data as opposed to emotion.
Okay, good points, Tyler. Habit number 2 that we have rated here is we will talk to investors many times, and first of all, they've done the right thing. They started investing. That's number 1. That's great. You're not too young, you're not too old at any particular time to start investing, so that's good. However, they will try to buy value investments too often. In theory, it sounds wonderful to buy low consistently and then hope that it's going to get high. That's the American dream. It sounds great. But sometimes there's a reason investments are at a low. And many times we'll see investors trying to buy value at a low too often. So the example comes to mind. Tyler and I met with a younger guy. He was in his 20s, did a great job getting started. But his theory was he wanted to buy everything he possibly could at 52-week lows. And when you looked at his portfolio, unfortunately, it languished pretty significantly during the biggest bull run in the history of the United States, which is 2009 through current date. And part of the reason is if you focus just on buying any particular stock at a 52-week low without knowing the history of that stock or that investment, without seeing particular patterns, without knowing why it's at a 52-week low, many times it's going to continue to languish. So we like to look at a well-diversified portfolio where you have growth in income, you have some international positions if it makes sense with what's going on right now with some of our tariffs and so on. But you typically like to carry value also as a hedge against some of your growth positions. Growth typically will get hurt more than value when the market starts to show some instability and volatility, typically. So a hedge is, what you do is you will put something in to balance the positive or negative of a different holding. So you can use some value there. But just to go pure value, especially when you're in your accumulation stage of your life, 20s, 30s, 40s, and even 50s, many times is not taking the right approach. So we'd like to have some growth positions in there too. We'd like to have some income producing positions, and of course carrying cash also.
Yeah, good points, Dean. Again, it's important to be diversified when it comes to the different type of method that you use. But yeah, we see it where when people try and buy value too often, oftentimes they're buying stocks that might be down and depressed for a reason. And what we like, usually what we like better than value is momentum investing, where momentum investing is actually the opposite, where what that is different companies that have exhibited the most growth over the last 52 weeks. So stocks that are actually around a high point typically tend to perform better in the coming 6 months to a year, even though they're at a high point, because they're displaying that momentum. And you find that in a lot of different growth-oriented companies, where if you look over the last 5, 10, 15 years, momentum investing has actually offered more returns than value. But again, it's important to have a little bit of both, because value, as you mentioned, Dean, can be a hedge. But momentum at the same time is usually where you're going to find more growth. And we see when we talk about momentum, oftentimes that might be different technology companies, different retailers, different healthcare and pharmaceutical companies. A lot of the industries that are growing and that we project to see the most growth in the coming 5, 10, 15, 20 years, usually those are the momentum companies, whereas the value could be industrials, telecommunications, consumer staples, companies that have been around for a long time, and they can still offer growth potential, but that's not their main objective. Their main objective right now, they've already grown, they're already as big as can be, so they want to provide that value to the shareholders. Usually your value companies have higher dividend payouts, but at the same time, they're not going to be as volatile as some of your momentum stocks as well. So ultimately, what it comes down to is to make sure that you have a different mix, to make sure that you're diversified between your momentum, your growth, your value. But it's trying to buy value too often can ultimately be a mistake.
Okay, good points, Tyler. We'll talk about habit number 3 that we see in the office, and again, a bad habit we'd like you to overcome, and that is people don't pay attention to interest rates. Now, we're not asking you to be an expert in finance or investments. That's why you're meeting with us or your financial advisor. But you should still know how interest rates affect investments and retirement income plans and cash positions. So pay attention to interest rates. We will hear some investors say, well, we need to put bonds in our portfolio for protection. That's been talked about for 50 years, but people really don't understand how the bond really works. And when you explain to them that, yes, we do want to have some bonds in your portfolio for protection, however, they're not giving a whole lot of gain at this particular time because, and then you explain to them how a bond works. It has an inverse relationship when it comes to interest rates. As interest rates go up, bond prices go down. As interest rates go down, bond prices go up. So you have to explain that to people. But there are also different investments that are interest rate sensitive. Real estate investments in the market, you can get some mutual funds or exchange traded funds or individual stocks based on the real estate market. That is interest rate sensitive. Why? If mortgages are too hard to get because interest rates go up and mortgages start to tail off, of course, those investments are probably going to cool down also. As rates go down, mortgages tend to be easier for people to get, or they feel better about getting them. Those investments typically go up, not always, but typically go up. But again, you have real estate investment trusts too. Those are interest rate sensitive. So understand how interest rates work. If you're an investor and interest rates go down, you have to look at it much differently than if you unfortunately are carrying a lot of debt. When interest rates go down when you're carrying a lot of debt, that's a good thing. When interest rates go down when you're an investor, especially in cash or fixed positions, that's typically not a good thing. So Tyler, anything else I'm missing there on interest rates?
Not paying attention to interest rates is a big one because it affects the market and overall economy a ton in today's day and age. And one other thing that people don't take into consideration, people, they might know bonds and real estate, mortgages, different things like that obviously are affected by interest rates, but stocks in general, so the stock market also is affected by interest rates too, because in general, stocks don't like when interest rates are increased, because what happens is plenty of institutions and people, they will sell off different stock investments when interest rates increase, and they will use that and go into something like bonds or cash or CDs or different fixed investments, because when rates go up, especially right now, if rates go up a little bit, they can use that money then to take it from stock market, which they take risk, and then they can go into something safer where they're actually getting a little bit more of a rate of return when interest rates increase. So usually stocks go down when interest rates increase, and it also happens at a company or a macro level as well. And what I mean by that is a lot of the big Fortune 500 companies, they're borrowing millions of dollars every day, and right now with rates at a low point, they can borrow a ton of money each day and pay a very low interest rate. But then if interest rates go up, then companies aren't going to be as willing to borrow anymore because they're going to owe more on the money that they borrow. So they don't borrow as much, and then the market views that as an economic slowdown is what it's called, where if companies aren't borrowing as much, they're not going to, therefore they won't spend as much and they won't use as much to turn that around and grow their company and stimulate more of the economy. So interest rates going up, especially when they go up pretty rapidly, is usually viewed as an economic slowdown, and it can really hurt the stock market. So very important to pay attention to interest rates, whether they go up or down, whatever direction they go, they will affect the market in one way or another, and that is stocks, bonds, real estate. So ultimately pay attention to interest rates, because not doing that could be a bad investment habit.
Okay. Before we continue, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, the next bad habit we're going to talk about as it relates to your investments is not being aware of the economic business cycle. Now that sounds, well, first of all, it's a mouthful, but secondly, most people are going to say, well, of course I don't know anything about that. But really what the business cycle is, it's very basic. It's talked about in a lot of the Morningstar and investing.com, and you hear about it all the time. The business cycle, you probably have heard about it. It's how our economy works from a monetary standpoint and from an economic standpoint. And what that means is if you can envision this, it just shows ebbs and flows, peaks and valleys. That's our business cycle. And you'll hear people talk about we're at our peak right now. So, envision that we're at a peak right now of the business cycle and we're coming off peak, or people will say we're the end stages of peak. And what that means is if you can envision coming off that peak and you start going down, that downslide is typically recession. You're going off of peak, you're going into the downside, which is recession. And then you get to the bottom, you bottom out, which is considered trough, or in some instances, unfortunately, depression. Okay, so that's what the business cycle does. And then what it does do is it starts to come out of the end of the trough and it starts the growth going back up again. You hit peak and then the cycle starts all over again. Well, the reason we say that's important to understand where we're at in the business cycle, investments fit into the business cycle. There are certain investments that do very well during certain times of the business cycle. There are certain investments that do very, very poorly during certain times of the business cycle. So if you look at peak or the latter stages of peak where most people think we're at right now, you have, consumer discretion and growth still doing very well. You hear of the FANG stocks and you hear of people in some growth opportunities yet. But what happens is as we start coming off peak and there's word, and we hear it in the news right now, people are talking about the possibility of recession. What we recommend is people start building a little bit more cash because we've been at such a high. Let's take some of those gains off the table. Let's build up cash. Building up cash is a term for saying you sell some of your investments at a gain and you take that gain and just put it into the money market position within your portfolio. So we have a buying opportunity when that time comes. But when you come off peak and start going down the slope here a little bit to recessionary times, you want to get a little bit more defensive with your investments. You want to look at things, and people say defensive. It's typically beverage companies. It could be tobacco carriers. It could be consumer staples, such as those companies that make, diapers and consumer goods, the Procter & Gamble's, Kimberly-Clark, the Church & Dwight's, things like that. You might also want to look at utilities. Utilities typically do better when the market is starting to ebb lower off its peak. And then once you start getting towards the bottom of trough, you really need to see what happens here, whether it's a regulated recession we're coming out of, or it's a deeper, significant downfall like we saw in 2008, which was more of an economic collapse. Then that depends whether you go into bond or cash positions and just keep all those gains that you've created from the top so you can slide into the trough. Tyler, what else am I missing here?
Yeah, Dean, very good points. Again, just important to note what stocks might be or might fit into that economic business cycle. And usually what we've seen, and this is very true over the last few years where we were, at least for the stock market, in a growth phase, and what you see typically are companies, again, technology, pharmaceutical, healthcare companies that over the next 5, 10, 15, 20 years are very growth oriented. Those are the ones that when the economy is peaking, when the economic business cycle is peaking, usually are going to do the best, which is what we've seen. Again, just technology and healthcare being two of those sectors. But then what happens is once we go over the peak and start heading toward the bottom to potentially a recession, that's when usually everything shifts defensively and some of your value might perform better. So again, you have your defense sectors, utilities, telecommunications, consumer staples. So a lot of those companies, they're going to hold up towards the bottom of a recession. You have things like Procter & Gamble, Walmart, different companies that hold consumer staples where, whether you whether the economy is booming or it's doing bad, there's certain things that everyone is still going to need, different toiletries, toothbrush, different things that no matter what happens, you're still going to need it. Whereas during the growth phase, especially you have different technology companies where if we're in a growing and booming economy, those are what are going to, at the peak, that's what's going to provide the most growth. But towards the bottom, towards a recession, not everyone is going to go out and buy expensive technology. So again, when it comes to the economic business cycle, you want to be aware of it because that will dictate and determine what sectors usually are performing the best within the stock market.
Okay, good points, Tyler. Okay, the next one, this one we hear quite a bit too in overcoming this bad habit, and that is investors will say, I'm only going to buy what the experts buy. And I mean, that does sound good because you want to piggyback on their success, but you also have to be aware of some of their failures too. Okay, so the one that we hear a lot is, if Warren Buffett owns it, I'm going to own it. Well, we absolutely love following the Warren Buffett story, and let's face it, he is probably the most well-known investor and successful investor in our generation, our time. But do understand that Warren Buffett, typically focuses on value, which is good because he is managing billions of dollars, and if he has investments that only creep up a half a percentage point, he can make millions, if not billions of dollars for shareholders. So do understand it's just based on pure bulk and volume. Wonderful holdings, but it's typically, insurance, industrials, financials, transportation, such as railroad. So understand if you just buy into those holdings that Warren Buffett holds, many times you might be a little bit disappointed because when the market is showing some significant growth, you might be pretty stagnant. However, on the flip side, when the market does show significant volatility, you will probably show a little bit more stability just due to the value investments that are held by Warren Buffett. Again, understand that things change all the time. He's got some growth and dividend growers in there too. He's got growth with Amazon now and with Apple. But again, don't just blindly go in and say, I'm going to buy what one of the most well-known investors of all time has. Let's look at your own situation. Let's look at your situation. So for instance, if you're within a couple of years from retiring, and you do have some safety mechanisms in place for your retirement, wonderful. If we need to pick up some growth opportunity here, we need to look at that. Are you going to get significant growth out of all those holdings? Probably not. You're going to get a little bit more stability, though.
Yeah, good points, Dean. This is a big one, too, that we see a lot, buying what the experts buy. And it's just important to remember and to realize that no investment strategy is the exact right strategy or everyone would have it. So there's a certain place and time for different investment strategies. Just like Warren Buffett's portfolio right now probably isn't the best for me or for you or for a number of other people, but it also probably is okay for a number of people as well. So buying what the experts buy can be a bad investment habit that can be hard to overcome because, again, you hear someone, especially as successful as Warren Buffett, and you want to replicate that strategy, but it might not be as growth oriented as you would like for someone who's in their 20s, 30s, or even 40s. But at the same time, it might not have, or it doesn't have any protection if it's an all stock portfolio for people who are in their 60s, 70s, or 80s. So that's the other thing to keep in mind, is that ultimately it depends on exactly where you're at and what you're trying to accomplish is what's going to be right for you. And what the experts buy often isn't the right thing for everyone out there. It can be okay for certain people, but just remember that buying what the experts buy isn't always going to be right for your situation.
Okay, good point, Tyler. The next habit we're going to talk about is not understanding how dividends work. I think most investors are familiar with the term dividends, but they really don't understand how a dividend works or the power behind dividends. And what happens many times, people will come in and just they think mathematically it works this way. If a dividend has a 2% yield and they have stock X that they have in their portfolio and it goes down 2% and their dividend yield is 2%, they think mathematically they're back to zero. It doesn't necessarily work that way. Also understand too, just like any investment, time helps. So if you have a dividend-heavy portfolio, and you're holding it for 6 or 8 or 9 months, and you don't see a lot of growth there and want to sell it off, remember that is not the purpose of a dividend-heavy portfolio. It's to accumulate those dividends, reinvest them, and then over time it will create a more robust portfolio. Also, dividends are a wonderful thing to have in retirement, where people can say, well, I'd like to keep the principal that I put into this particular investment, but then every month I would like to have the dividends put into my checking account or savings account. Great way to create income, but just understand how dividends actually work. If the dividend yield is very high on a particular stock or investment, chances are that share price of that investment or stock has gone down. Okay, again, sort of works as an inverse relationship. As the dividend yield goes up, typically the share price goes down. Tyler, what else am I missing here with dividends?
Yeah, so not understanding how dividends work is a big one. But ultimately, the dividends, they're paid quarterly. Something that people don't do oftentimes that they should is something called a dividend reinvestment plan, where when companies pay out dividends, you can have them automatically reinvested to buy more shares of that stock whenever they're paid out. And that's what you want to do when you're in the accumulation phase. So when you're still growing your money, when you're not taking it as income, what'll work best is if you have those reinvested. Many brokerage firms out there, they don't charge any fees for that, but you can basically buy more shares whenever. You can have those reinvested right back into your account. So you want to take advantage of that. And then also an important term is the dividend yield, which is the annual dividend divided by the stock's share price. And that's a percentage of the dividend return each year that a stock has. And as you mentioned, Dean, oftentimes we have people come in and they want to go pick out different stocks that have a high dividend yield because they like that income and they get that paid out as income. So for example, if a stock is yielding a 3 or 4% dividend, that's 3 or 4% per year of the value that they have that they get paid out in the form of income that they can take each year, which it really helps when people are retired for some extra dividend income. But it's important to know too that the dividend yield changes with the stock price so often, unusually high for stocks that are falling quick. So for example, if you have a stock that is going down quickly, it's going to have a very unusually high dividend yield, which probably isn't a good thing. It doesn't mean that it has a strong dividend. It simply means that the stock price is falling a lot. So you don't only want to go out there and get stocks with the highest dividend yields, because often a lot of those companies are going to be ones that have a very low share price that are at a low, and you're not going to make much money from those. So again, it's just very important to understand how dividends work. They can be a very powerful tool, not only when you're accumulating money if you're younger, but also when you're retired and you can take those as income. But again, important to understand how they work.
Good points, Tyler. That's all the time we have this week. See you later, and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.